The news of the day is certainly First Republic went into receivership after the stock being down, I think, another 50% on Friday. They reported earnings last week where they disclosed just how much money they had lost. And to break it all down for you in terms of why this bank could no longer exist, this was a bank who made a bunch of loans just like many other banks did over the last few years at very low interest rates. In First Republic's case, they were making pretty big mortgages over this period of time, and I don't know about you, Mark, but I personally have a mortgage locked in at 3.25%, which I consider to be a pretty good deal. There are others with rates under 3%. What they found in the most recent quarter was that the rate that they were paying on the rate that they were paying on their liabilities, and their liabilities are not the loans. Those are their assets. You got to think of this from the bank's perspective. Their liabilities are your deposits. And so the rates that they were paying on those deposits of one sort or another, in fact, exceeded the rates they were receiving on their assets. And their assets would be a combination of mortgages, treasury bonds, et cetera, et cetera. And so that is not exactly a formula for long-term success. You just think about that for a moment in terms of your own budget, right? If you have more money going out on a quarterly basis in terms of expenses than there is coming in income, then something's got to change pretty quickly. And in this case, it was the change coming that JPMorgan Chase would now be owning you. So that's where things stand. As of Monday morning, if you walk into a First Republic bank, you are now a customer of JPMorgan Chase. They have accepted all the liabilities of that bank, including any deposits that were uninsured. So that was, to me, a rather minor question to be answered because we think we all knew the answer, but that was a question to be answered on Friday was, hey, is this going to be the same way as SVB and Signature Bank in terms of ensuring all deposits insured and uninsured? Quite honestly, I don't know who still had uninsured deposits at First Republic after the $100 billion that went out the door.
This is the
last
problem
few
when
weeks.
you wait so long to resolve it. They're all gone because nobody knows what ultimately regulators and the Treasury Department are going to do to resolve the situation. So
yeah, I mean, there's
the
a debate.
bad money drives out. This is not an actual application of this little law, but bad money, I'm misapplying this phrase, but bad money drives out good.
Yeah. I mean, I'm not sure that they should have done this, but it's an interesting thought exercise to think about. Hey, if the FDIC and Treasury and the Fed maybe had come together and passed some sort of temporary rule saying all deposits are insured up to, above FDIC insurance limits for the next 9 months, I think it is questionable as to whether or not First Republic would have failed in this fashion. I'm not sure. I'm not saying that they should have done so, but in the absence of that statement,
it would have cost us less. Would have cost taxpayers less, almost certainly. The foot dragging, if you will, and I'm not saying I could have certainly. Look, I don't know the first thing about it. I've never been involved in bank resolutions, but experts have pointed out that had this been done more quickly, it would have been cheaper for taxpayers.
Yeah. So, I mean, as it stands here, the FDIC is going to be basically taking a loss, an estimated loss of $13 billion. Now, they don't really know what that loss is going to be. Effectively, the deal here is that the FDIC is going to share on losses with JP Morgan on First Republic's loans, and they estimate those losses are going to come to $13 billion. They're also going to, JP Morgan that is going to be receiving about $50 billion in financing from the FDIC. Presumably, they're getting some pretty good deals on that financing rate. So, to your point, Mark, yeah, I think there's an argument to say, hey, if the FDIC had come out right after SVB and said, hey, we rescued all deposits above FDIC limits here, we're going to do the same for every bank in the country for a period of time until things are resolved, would there have been a run on this bank? Would the run on the bank have, just waited until 6 months were up? I don't really know the answer to all those questions. It's really tough to say. It's really tough to say where these assets go from here on the JP Morgan side. But one thing, and there's some evidence of this that I'm pretty certain of, is that the bank regulators themselves, I don't think are likely too excited about JP Morgan Chase taking over this bank. They're not terribly excited. I mean, better than nobody taking over this bank.
They're upset at the outcome. They can look in the mirror.
Yeah, but the idea that one of the large four were presumably, I mean, this is my assumption. The fact that JP Morgan Chase stepped in here to make this deal happen, to me insinuates that no smaller banks were either healthy enough or willing to make this deal.
No, nobody wanted it. The assets were there. Everybody knew what was available. Nobody wanted it. JPMorgan already controls more than 10% of deposits in the United States. Under the current regulatory regime, they should not have been allowed to grow, as you pointed out to me this morning, Mike.
Yeah.
So an exception was made because, go ahead, sorry.
And, this deal is to the point where JPMorgan Chase is so large that the deal itself actually has to go through the OCC, which is the Office of the Currency and
Control of the
Currency.
Controller
of the Currency has to approve this deal because of the size of JPMorgan Chase. And so what does that tell you about all this? Well, I think it tells you that the health of the overall regional banking sector, where a lot of deposits fled out of over the last few days, the last 45 days or so, was not healthy enough to pick up this bank here. I don't think it came down to, JPMorgan Chase just so significantly outbid all the competitors there. I think it speaks to the fact that none of them were in a state to be able to do so.
Look, the good part about this outcome, as ineptly, arguably, people who are more qualified to opine on this than me have argued that it was not handled optimally. But that aside, contagion has been staunched. We've seen, right? Small banks are down. If you look at the S&P 600 financials, that index, that thing that measures the performance of smaller publicly traded banks, is down something like 10% since SVB failed on March 10th. But the S&P 500 financials, bigger banks and financial services companies, roughly flat, up about a percent. So there is this weird dichotomy. The worries seem to be directed at smaller, less diverse regional institutions like your SVBs. So in a sense, the contagion and the macroeconomic implications have probably been moderated, so to speak. There is no obvious knock-on. There is no obvious contagion to this point. So in that sense, in other words, people aren't lined up at banks.
Yeah.
Banks haven't stopped lending. This is not, as Chuck and you like to point out regularly on the show, this is not 2008.
Yet. Yeah, I think that
Nobody's
the problems in the banking sector are inherently different from 2008.
Yeah, nobody
right
said.
now.
By the way, I'm not sure I love that argument. Nobody said that it was. That's almost a false choice.
Sure.
It's not. Well, it's either 2008 or everything's great. Right. No, there's a lot in between on that spectrum.
Yeah, no doubt. I think this moment in time is defined by a run on banks combined with a bunch of assets that are worth a heck of a lot less than they were 18 months ago. The banking sector in 2008 was defined by a run of banks that were backed by a bunch of assets that not only were worth a lot less than they were 18 months prior, but nobody had any idea what they in fact were worth. That's different, right? We know what the assets are worth that First Republic has. Their treasury bonds, their mortgages, you can easily value them. The mortgages and collateralized loan obligations that were sitting on banks' assets and books back in 2008, everybody looked at those. They were in free fall, and you had no idea what they were.
Look at what equities and financial conditions have done generally since SVB failed on March 10th. Stocks are up 8%. This is the S&P 500 now, not small banks. They're down by about the same amount. But the broader macro picture suggests everything's running fine. Stocks are up 8%, the S&P 5, that is. Financial conditions, which economists look at to get a sense for how Fed policy is working its way through the economy, financial conditions have eased since, unbelievably, and they're getting easier incrementally over the past couple of weeks since March 10th. They tightened a lot, and now they're getting easy again. There's no indication, at least to this point, that there are knock-on effects to lending in the broader economy to this point.